BlackRock reported their earnings yesterday, and this seems like a great opportunity to take a closer look at the stock. In this video, we're going to take a look at the Q3 earnings, the financials of the company, and then try to come up with the fair value of the stock by calculating an internal rate of return based on free cash flow. You can see the stock is up significantly today, but the past month have been very rough for investors, as the stock is down 41% from its all-time high. Revenues were $4.3 billion, down 14.6% year over year. That is mainly because of lower income through base fees for the assets under management and lower performance fees. BlackRock slightly missed the consensus estimate for revenue, but they posted better than expected earnings, mainly because of its technology platform Aladdin and lower expenses. If you don't know what Aladdin is, I highly recommend you research the topic, because that is a big competitive advantage of BlackRock. We can also see that the assets under management decreased over 16%, but that's due to the stock prices going down. It's good to see that the total net flow still remained positive with nearly $17 billion. I also like to see that they repurchased shares worth of $375 million this quarter. They already repurchased shares worth $1 billion in the first 2 quarters, which gives us a buyback yield of 2%. Let's take a look at BlackRock's financials. The current PE is 14.9, which is below BlackRock's 5-year average. The forward PE is 16. The market cap is $85 billion, and we get a dividend yield of 3.4%. Combined with the buyback yield, we get 5.4%. Over the past 7 years, revenue per share increased every year. I really like to see this. We get to have the top line revenue growth. Earnings per share and free cash flow have been a little bit more volatile, but they also grew substantially over the past 7 years. When it comes to BlackRock, I think that the annual growth rate over the last 10 years is more important. That's mainly because BlackRock's business model remained the same during those years, and there's a direct correlation between BlackRock's and the market's performance. Revenue grew 8.6% and cash flow grew 15%. It's great to see that cash flow and earnings growth is in the double digits. We can also see that BlackRock already pays a high dividend, but keeps growing this dividend at a high rate, which makes it very interesting for dividend investors. Now that we have an understanding of the financials, let's get into valuation. But first of all, if you liked the video so far and are interested in more stock analysis videos, feel free to leave a like and subscribe to my channel. We can see the number of shares has been steadily declining, and although revenue is expected to drop, analysts expect a record revenue in 2024, which seems reasonable to me. We just have seen that BlackRock had an annual revenue growth rate of 8.6% over the last 10 years and 15% for free cash flow, which is in line with the expected compounded annualized growth rate for the ETF market. I like to be a bit more conservative and use 8%, which should be roughly in line with the overall market performance. Although I use a 6.5% fair free cash flow yield, we can see that we still get an internal rate of return of 12.7%. In the best case scenario, I expect free cash flow to grow a little bit faster and then slow down over time. In this scenario, we get a 14% internal rate of return. In the worst case scenario, I expect BlackRock to slightly underperform the market with just 6% growth year over year. Although this is very conservative, we still get an internal rate of return of 9.9%. If we look at the combined result, we could get an internal rate of return of 12.5%. which is a market-beating return, and when the stock price drops, we can see it gets more and more attractive. This is no financial advice, and you have to do your own due diligence. I personally really like BlackRock stock. I often mentioned that I look for high free cash flow stocks, as a lot of data suggests that those companies perform better during a recession and in times of high inflation. BlackRock has a high free cash flow and a great business model with reoccurring revenues. I believe in the future of ETFs, and therefore I believe in the future of BlackRock's business model. They are also doing buybacks, which I also like to see, especially during those market times. The company has low debt, so rising interest rates won't be a problem. And we have seen that even the worst case scenario seems to give us a market-beating internal rate of return. Therefore, I already bought some shares of BlackRock and will continue to add more if the stock price drops further. This has been a valuation of BlackRock. Thank you for staying till the end and see you in the next one.